Hi everyone, thank you for tuning in to the second episode of ESG Roundtable Talks. My name is Albin Axelsson. You're probably familiar with who I am, but for those who are new to this channel, I am the founder and CEO of ACCC Consulting. And ESG Roundtable Talks serves the purpose to provide food for thought, as well as deep insights into the various regulations as well as practices when it comes to ESG and sustainability. The firm I founded is specialized in providing hands-on and also tailor-made solutions for fund managers as well as listed entities, but insurance companies, when it comes to complying with this myriad of regulations pertaining to the sustainable finance framework. And today I have the luxury to speak with Alex Golding, who is a reporting expert and specialist for Seneca ESG, to provide ESG data management platform as well as facilitate the reporting exercise for many of the undertakings as reporting entities of CSRD. And in today's episode, we will discern the concept of double materiality, and we will also discuss how to report to make sure that what you communicate makes sense to external stakeholders. So thank you so much for tuning in, and I'm super excited to kick off this second episode. So let's dive into it. Thank you. Exploring double materiality under the CSRD, legal definitions and practical approaches. The Corporate Sustainability Reporting Directive, CSRD, is a regulatory framework aimed at enhancing the transparency of sustainability information provided by companies. Has introduced the concept of double materiality. This concept challenged the organizations to evaluate not only how sustainable issues are affecting their business, but also how their operations impact sustainability matters. However, many companies are finding it difficult to precisely define and apply materiality in this dual context, often resulting in errors by either overestimating or underestimating what should be considered material. Legal definitions of materiality under the CSRD. The term material under the CSRD refers to information that reflects the environmental social governance, ESG, aspects significant enough to influence the decisions of stakeholders and assess the company's impact on society and the environment. While this sounds straightforward, the practical application can be complex. The European Financial Reporting Advisory Group, EFRAG, and the European Commission have provided some standards, such as the European Sustainability Reporting Standards, famously known as ESRS. Yet clear practical guidance remains sought. For instance, ESRE 1 mentions factors like scope, scale, reversibility, but fails to define precisely what these factors reach a threshold of significance. This leaves companies in a quandary over how to implement these criteria effectively. The guidance often suggests that companies should rely on their judgment, yet this advice can be nebulous without concrete examples or benchmarks. The normative nature of materiality. A critical oversight in the development of these guidelines is the assumption that materiality is an empirical concept, measurable and quantifiable like physical quantities. However, materiality in the context of CSRD is inherently normative. It involves value judgments about what information is significant enough to influence the decision of the stakeholders, including investors, customers, and the broader community. This normative judgment requires balance of interest between the reporting entity and its stakeholders. It is not merely about quantifying impact, but evaluating them through the lens of societal expectations, ethical considerations, and potential long-term effects of the company's social license to operate. Herein lies the challenge. Normative judgments can vary widely among different entities, influenced by their values, operational context, and stakeholder expectations. Practical approaches to apply double materiality. Given the normative and somewhat subjective nature of materiality under the CSRD, companies should adopt a structured approach to make this concept more tangible and actionable. First one, stakeholder engagement. Regularly engage with stakeholders to understand their concerns and expectations regarding sustainability issues. This interaction can provide critical insight into what stakeholders deem material. Scenario analysis. Conduct a scenario analysis to understand the potential impacts of various sustainability issues on the business and vice versa. This can help assessing the scope, scale of impacts in a structured manner. Benchmarking. Look to industry peers and sector-specific sustainability reports to gauge common practices and materiality thresholds. This can offer a comprehensive perspective and help in setting internal benchmarks. integrated reporting. Develop integrated reports that combine financial and non-financial impacts, providing a holistic view of how sustainability issues affect the business and are affected by it. This integration can help in making more informed, balanced judgments about materiality. Continuous review and adaptation. Materiality is not static. It evolves as new information emerges and as societal norms shifts. Regular reviews of materiality assessments are essential to stay aligned with these changes. In conclusion, understanding and applying the concept of double materiality under the CSRD requires a deep appreciation of its normative basis and the practical structured approach to its assessments. While the regulatory framework and standards like the ESRS provide a starting point, companies must develop robust internal processes and engage actively with stakeholders to navigate the complexities of sustainability reporting effectively. This approach will not only comply with the CSRD, but also enhance the quality and the relevance of the information reported, supporting better decision-making for making all stakeholders involved. Welcome to ESG Roundtable Talks. Today I have Alex Olding from Seneca ESG, and this is a deep dive into the world of sustainability reporting. And today we're going to focus on the intricate dance between financial and impact materiality under the Corporate Sustainability Directive, famously named CSRD, and then the European Central Bank's ECB guidelines on environmental and climate-related risks. Joining us today, obviously, is Alex Olding, and he will sort of touch base on how these regulations are interconnected, how they overlap, as well as what undertakings, so reporting entities should think of. And yes, I am super excited to speak with him. So I would, of course, give the floor to Alex now. So please, can you introduce yourself to our audience today?
Of course. Thank you very much for the introduction, Alvin. My name is Alexander. I'm one of the ESG solution specialists from Seneca ESG, and I represent the firm in our operations across Latin America and the Americas region in general. So my conversation today with Alvin is one that I'm most looking forward to, touching on some very key and important developments in the regulations area for the European market. And so thank you very much, Alvin.
No, thank you. We are super happy from ACCC Consulting to have you on board on our ESG Roundtable Talks. This is our podcast series, so this is our second episode. So once again, thank you for taking your time to join us here and speak of these very important topics. So we will start, I would say, to deep down into the subject. So I think it's feasible as well as interesting to start from the beginning, since you are a reporting expert. You know that it starts with double materiality. And could you please explain to me sort of the concept of double materiality from CSRD's perspective, as well if you can elaborate a bit on how you think maybe banks should approach this from an ECB perspective too?
Yes, of course. Thank you. Thank you for the question, Alvin. So I suppose first of all, to start off, in contrast, the CSRD introduces this double materiality perspective that defines and expands on the definition of materiality beyond the financial impact to include how the company's operations impact the environment and society. So this dual lens requires companies to both report on sustainability issues and how they affect their business, financial materiality, and on how their business practices impact sustainability, so impact materiality. Now, this approach is not only about managing risks, but also about reporting on the broader societal and environmental impacts, thus requiring a more well-rounded view of what is deemed material. Now, I like to say that this can be broken down into 4 different points. So first of all, on the holistic risk management side, so banks under ECB guidance are developing robust frameworks as we speak for managing the environmental and climate risks, similar to what could be leveraged under the CSRD. So banks can utilize their established risk management under the CSRD and their risk management practices that exist to assess the financial implications of environmental and social issues. Now, furthermore, on the dedicated committees and expertise side, the creation of dedicated committees within banks, as described by the ECB for overseeing climate-related risks, can be adapted to also cover broader sustainability issues under the CSRD. Now, in terms of the strategic integration, both frameworks emphasize the integration of these considerations into overall business strategy. Banks can adapt these strategic planning processes recommended by the ECB to ensure that sustainability issues are embedded within corporate strategies, thus aligning with many of the CSRD's ESRS requirements for considering both types of materiality. And finally, on the stakeholder engagement and reporting side, so the ECB encourages banks to consider international agreements and local policies in their assessments, similar to the stakeholder-focused approach of the CSRD. Now, banks can use this orientation towards global standards and stakeholder expectations to inform their sustainability reporting and engagement strategies under the CSRD. So overall, this approach to assessing the materiality of environmental and climate risks offer certain lessons that we can take away for how we can implement the CSRD's double materiality concept. And by leveraging these established risk management frameworks and strategic integration processes, banks and other companies or corporates can more effectively address both the financial impacts of sustainability issues on their operations and the impacts on the broader environmental and social goals.
Great. Thank you so much. I think that is really what I think our audience are on a daily basis struggling with, sort of this normative approach in relation to, I would say, the broader sense of various stakeholders, and then ultimately, if it has also, of course, a financial impact. So thank you for sharing your thoughts on this topic. And I think it's also kind of something we will see an evolution of. I think it's wise, obviously, to start, as you now very thoroughly walked us through, specifically for these type of entities. So then we will move forward to our next topic. The second topic will be strategic integration of ESG into business models. And a question to you is, how important is it for banks or financial firms or other sort of bigger players to consider ESG into the overall business strategy?
Thank you, Alvin. So I suppose answering this from the perspective of Seneca ESG and how we look at this. So we provide a comprehensive suite of tools for carbon accounting, corporate ESG metrics tracking and monitoring, and of course on the financial institution side to establish your own custom ESG assessment framework. Okay. Now these tools offer features which can help institutions in the alignment of their ESG requirements and their strategy with regulatory requirements such as the CSRD and guidelines from institutions like the European Central Bank. Now, to elaborate a bit further on what specific offerings this includes, so on the regulatory compliance module, we offer a dedicated module that is specifically designed to ensure compliance with regulatory frameworks such as the CSRD's ESRS guidelines and also those of the ECB. So this module provides a centralized platform for tracking and managing compliance requirements, including the data collection side, aggregation, approval and audit, and reporting and disclosure obligations. Furthermore, on the ESG data management side, the platform that we have, which we offer to our clients, provides this robust data management capability to help the institution collect, organize, and analyze this data in accordance with these regulatory standards. So, for example, if you are a company and you're choosing specific standards from ESRS that you'd like to comply with, not all, but certain ones, then that's something that you can do to create your own custom ESG assessment framework to comply against. And these features for data validation, normalization, and auditing help ensure accuracy and reliability in reporting. Then on the reporting templates and standards side, we also provide pre-built reporting templates that support commonly used ESG reporting standards such as GRI, SASB, TCFD, Task Force for Nature-related Financial Disclosures. So these templates all align with regulatory requirements and facilitate that streamlined reporting process. So I like to say that where typically your previous processes involved using Excel, which is typically the go-to with many of the corporates that we speak with, that's fine. There's no problem with using Excel. But of course, once you begin to scale as a company, and this has been my observation, the whole process of ESG reporting can become a little bit inefficient, right? Because you've got to share this document across multiple sites, installations, multiple users. You know, there's no designated number of users within the Excel file. So it becomes a little bit messy. And so the purpose of what we're trying to achieve here in response to this question is provide an integrated, streamlined workflow where everybody is assigned their role for their designated site and installation and physical geographic location so they can then begin their reporting process. Now, to elaborate even more, on the stakeholder engagement side, we offer institutions to engage with key stakeholders. Now, that might include regulators, investors, customers, and employees to gather feedback, address concerns, and demonstrate commitment to ESG principles. Now, this might include features for stakeholder surveys, feedback collection, or transparency initiatives. And finally, on the training and education side, so we support institutional capacity building in ESG compliance. So through the relationships that we develop globally, we help provide training and educational resources on relevant regulatory requirements, best practices, and emerging trends in sustainable finance. So this helps institutions to stay informed and up to date with some of these evolving regulatory landscapes. I mean, I can give you an example. Right now, in the mining industry, I think the ICMM and IRMA standards, which are under consultation and review, you know, this is a very key standard for companies operating within the mining sector.